Okay, well, it is 8:31 on my clock and my watch, and I am going to let more of you trickle in as we start another installment of our coffee chats with Economic Alliance Snohomish County. We're going to queue up our presentation, and then we'll dive in from there. But I want to ask that each of you please add your name and what organization you're with in the chat, and welcome you to the Coffee Chats installation here. And then I'd also ask that each of you make sure that you mute yourselves if as you join. And if you have questions or comments, please add them into the chat, and we'll try to get to those time permitting. So welcome, everyone. This is Coffee Chats with Economic Alliance Snohomish County, and today we're going to discuss tax preparation for businesses. So it is December 6th, it's 8:30 a.m., and we are very thankful to have you all here today. Joining us today for our installation are two local experts to discuss tax preparation for businesses in 2023. We'll look at some current tax deductions and look at the opportunities to review new tax deduction rules that may apply to your businesses, specifically small businesses, and give some tips on how to prepare for the upcoming tax season in 2023. So this morning we have Kristine Fryrear, who is a partner at enrolled agent with Tax Partners Northwest. Kristine, thank you for joining us this morning.
Thanks for having me.
And then we have the gentleman here on the bottom of my screen, Dana Lashbaugh, who is actually the CPA and
You're right there, Gary.
Mine went blank.
There you all are. Okay. Lost you for a moment there. Are you able to hear me?
Yeah, we can hear you.
Okay, cool. And I was mentioning Dana's opening as the managing member with the CPA group. So Dana Lashbaugh, thank you for joining us. Kristine Fryrear, we really appreciate you joining us. We're going to start this conversation off without any other glitches with a conversation from each of our panelists to talk about just who they are, their organizations, and some little insights on what they've been doing. And then we'll dive into some Q&A about this tax season. So without further ado, please take it away.
All right. My name is Dana Lashbaugh. I'm a CPA. I'm owner of the CPA group over by Silver Lake, across the street from Silver Lake in Everett, Washington. And we have about 10 other CPAs here at the office and an admin team, and we prepare returns for the general public in the area. We also do compilations or compiled and reviewed financial statements, or our industry, we call it assurance work. But yeah, we prepare returns for individuals, businesses, estates and trusts, and not-for-profits. And let's see, we also help help clients plan ahead for taxes and help them with decisions and how they impact your taxes. And we work with local legal teams in helping succession planning and and tax strategy. So Yeah, I guess that's my business in a nutshell, pretty much.
All right. Thanks, Dana. Appreciate you sharing. Kristine, if you'd like to share as well.
All right. I'm Kristine. I am the managing member at Tax Partners Northwest. We have been in business for about 9 years in Linwood. Been doing taxes for, I think this is 22 years. I've been an enrolled agent for 16 of those. An enrolled agent, for those of you that don't know, is someone who specializes in tax. I don't have the same accounting background that Dana does. Complete focus is on tax. Work with a lot of small businesses, do a lot of individual tax returns, do a lot of tax planning for clients. How do we prepare for minimizing tax liability? Work with a lot of financial planners as to how to minimize tax liability as people transition into retirement. Do a lot of business meetings this time of year as we get close to the end of the year. What do business entities need to do? What things can they still do before the end of the year to minimize tax liability for the coming year? And that's me in a nutshell.
All right. All right. Well, folks, if you want to ask more questions of our two panelists, please look to your chat section. We really want to get to a lot of questions here. I want to set the stage a little bit for some brief Q&A, I guess. Are you all game for that, Kristine and Dana? We're good to go?
Sure.
Okay.
Sure.
All right. So we really want to dive into a few comments about different business entities. So for our viewers, Dana and Kristine, could you provide us a little breakdown on the difference between business entities and the difference between what that looks like in kind of the accounting realm and tax preparation?
I believe in the chat, there is a handout on choosing a different business entity types. So it's kind of a, what are some of the advantages and disadvantages of all of the different business entities? Sole proprietors, you've got a Schedule C on an individual tax return. Partnerships, there's more than one owner, they get taxed similarly to sole proprietorships. Corporations, C corporations or business entities, all their own, pay tax at that level, can also elect to be taxed as S corporations. LLCs, I don't know about you, Dana, but we get a lot of questions from clients. They've started an LLC. An LLC is a state designation. It is not a federal one. Okay, so depending on how many members there are in that LLC, is going to determine how you get taxed. If it's a single owner, the IRS is going to default you to a sole proprietor. If there's more than one owner, they're going to default you to being a partnership. So there are some elections that can be made if you are an LLC as to how you end up getting taxed. But one of the misconceptions is that an LLC is an entity all of its own. And that is not the case. Most of who we deal with are probably small proprietors, sole proprietors, small businesses. They have started, on their own, and especially the first year, there is not always awareness of what the tax consequence of a sole proprietor is. You've had a W-2 job, you have taxes taken out as a sole proprietor. That is not the case. So sometimes the first year is a little surprising. What can you deduct? What expenses are allowed based on your business type? How do you plan so that you don't have a huge tax liability at the end of the year? So work with a lot of clients and do some planning and education as to what you can and cannot do as a sole proprietor.
All right. Thank you, Kristine. And Dana, did you have any thoughts on that before we move on to the next question?
One of the things, there's, without taking up too much time, because man, you can easily fall into pitfalls and going into descriptions on there. And Kristine did an excellent job of describing the different entities. When you put business, when you create a new entity and you are, you're looking at trying to find deductions for that business, as many of our clients try to, we try to work with, and we try to find those deductions. One of the challenges that I get reminded now and then is, make sure that when you start a new business, that you put the assets in the business under the business name. For example, and vehicles are a common occurrence. So if you do use your vehicle, either have a reimbursement program, or if it's going to stay, if the vehicle is going to stay in your name, or put the vehicle in your business name that you're taking the deduction for, because the IRS can easily turn around and say, well, you can't take deductions if they're not in your business in the first place. So it's just a common thing that we run into. And one of the, unfortunately, well, I shouldn't say unfortunately, one of the things that I do in my spare time is I listen to podcasts. One of them's from the AICPA tax department, and that was one of the examples they used over this last week. Was it's a common thing that happens. It was brought up in a podcast this week. It's easy to miss, and now's the time. If you're going to have it in your business, and if you miss that step, make sure that your the assets of the business are actually in the business, so you can take the deduction.
Okay. Moving along, based on some of the entities that were mentioned here, can you highlight the new tax laws from 2023 tied to the business entities that were previously mentioned? How will they be affected based on these laws? Kristine, do you want to try, or Dana, do you want to dive in on that?
Dana, why don't you start on this?
Okay. All right. So the new tax laws in 2023. Well, we heard about the what is that? The Inflation Reduction Act, and let's see if I got a flyer for that. I know I do. So the Inflation Reduction Act. What that I'm going to try to find it where the print's not too small, but I'll do my best here. So on the Inflation Reduction Act, there was a lot of things that that were talked about. This was the act that people were, it became very political, and the odd thing about it is from my industry, or from Kristine's and my industry, is we actually would welcome more IRS agents, because there's nobody answering the phones when we have questions. And now we'll actually may have somebody to answer the phones. They probably aren't going to be armed with guns. But this is that very bill that we heard. Oh yes, there's going to be this. There's a bunch. The part that we are interested, that in the tax industry are interested in, and I'll share the screen here with you. Let's see here. Let's see. That looks like. Hold on a second. But yeah, the summary of it is actually mainly in the energy saving credits. So there we are. So hopefully this isn't too small for your screen. I'll try to zoom in to how this will affect each of us. A lot of the credits were actually for individuals. So the part on the right, the electrical vehicle credits, I'll get into here in a minute. There used to be, up until the end of this year, so this takes place January 1st next year, is for if you were to upgrade your house with new windows, doors, insulation, like the items listed here. It used to be where the credit would max out at $500, and Now it resets starting January 1st, and start, going into next year, that every year is 1,500. Was it? I believe the credit is capped. Oh, there it is, $1,200 at the top. And see that the first line, it basically summarizes it. But what the credits are, it's by type of upgrade that you do to the house. So if you do multiple upgrades, you're not automatically capped at 500 anymore. This is exciting for us because this rule hasn't changed in forever. So, I mean, what this also means is when you make these changes, if you're looking at making these changes, and we're still looking at doing this in December, if you could, I know doing Windows, you probably want to do that. A lot of this stuff you'd want to do, sooner the better if you're freezing. But if you can delay it, you actually get the credit next year and be able. These are tax credits, meaning that you're going to be paying this cost anyways. If more than likely, if you're doing these replacements, these are tax dollars. It's lowering your tax bill to the IRS. Not as exciting as the part on the right, where if you are interested in an electric vehicle, they totally revamped the rules, and there's two sets of rules. One ends December 31st. So the way they redid it is you still have the tax credit up to $7,500. The credit now requires that the vehicles are assembled at minimum in North America. The second part of it is starting January 1st, and you'll see this little chart down here. I'll just scroll down. How this works is the counts. I don't know if you remember, but if you were interested in buying a Tesla, you noticed that the tax credit went away last year. I think it was actually 2 years ago it got phased out at the end of 2020, because they sold more than 250,000 vehicles. This wipes out this law wipes out the count. So now it's based on your income, your adjusted gross income here, and that'll be pegged at inflation. But starting off, if your adjusted gross income is less than 300,000, you can get the credit, and you can actually get a Tesla again. And so Teslas and other vehicles that had been on the list and then they fell off now can qualify. And I haven't looked it up, but I believe that means also the Prius may show up, and it hasn't been on the list since 2008. So that would mean the new Priuses, the fully electric ones, we get the 7,500. There's probably a partial one, like they used to back in 2007. Additionally, it include all the other electric vehicles. It also includes if you buy a used one, and the used option, the adjusted gross income is halved. So here it is here, where it says where is it? New credit for up to $4,000 for used electric vehicles. So if you bought a used 2020 or 2019 electric vehicle, you actually get a $4,000 credit. But your adjusted gross income has to be a lot less. So not as many people will actually qualify for it. I hope that makes sense for everybody. So with the new restrictions of adjusted gross income, it looks like the government's targeting a different base or a different group for buying these electric cars. We have no idea if it's going to be successful or not, but it's the new rules that they changed. So this was the majority of as far as tax credits that rolled out for the Inflation Reduction Act. Is there anything in here that talks about inflation reduction? No. It was a gimmicky name, and I'll be the first one to tell you that it's very gimmicky. So, but yeah, the credit is mainly for energy saving.
All right. I know we'll have some additional questions in the chat. Please feel free to add those now, folks. Kristine, did you want to add anything or any elements to that question?
Well, related to 2023, there are a lot of things that are still on the table for Congress to decide before the end of the year. There were some credits that expired at the end of 2021, may or may not actually end up being in effect for 2022 or 2023. So Congress has a lot of work to do before year end to determine not only this year's tax law, but next year. Tax brackets are scheduled to stay the same. Mileage rate, reimbursement rates did change mid-year of 2022. Okay, so anyone who has a vehicle in their business needs to split their mileage between the 1st of January and the 30th of June, and then July 1st through the end of the year. New mileage rate will be set for 2023. But as far as credits and new tax law changes, ask me in January. Hopefully we'll have a decision before the end of this year.
Well, let me ask you both a few questions on tax deductions. So if each of you could kind of highlight your synopsis of how you define that, and then also are there any key tax deductions that businesses in each of these entity titles should be looking for to try to take advantage of, so to speak? So define tax deductions, and then give some insight on what businesses should be looking at to get an advantage.
Deductions are something that reduce the amount of income that you have to pay tax on. And depending on what type of business you are, there are obviously different things associated with each one, but tracking what your office supply expenses are, your insurance, and various types, breaking out the various types of insurance you have. Sometimes the deductions for that are different. Mileage rate we talked about. Dana had brought up earlier, putting assets in the business name, so the assets that are associated with the business. We have some depreciation choices related to that. So that also reduces the amount of income we pay tax on. There is something called bonus depreciation still, which means if the asset is under $2,500, you can elect to just expense it. And you can take 100% of any other assets you purchased, provided they qualify. You can take 100% of that value of the asset in the current year. One of the things that will change for 2023 is bonus depreciation is going to drop to 80%. But depending on the business and what your income is this year versus what your income is going forward is going to impact what recommendation we would make as to what depreciation type. So there are some choices related to that, for businesses that are purchasing assets. You have until the 31st to make that happen and actually have it in place to be used in your business. Do a good job of categorizing your receipts in areas that make sense to you as a business owner. Tax professional will figure out what to do with them and provide education related to that. One of the things for 2022, as well as far as deductions go, if there are any meal related expenses in or from a restaurant, that deduction is still 100% for 2022. If it's something you purchase from the store instead, deduction will be 50%. So do track, what is from a restaurant versus what is not.
Okay. Thank you, Kristine. Dana, you want to add any context to the tax deduction space?
Sure. So this time, if your company if you haven't done it yet, this is a good time of the year to go over budgets and see where you're at. Talk to your tax person, get a good idea of how much in taxes you would owe for 2022. Trying to make sure that those payments are timely. So why give the IRS any more and penalties and interest when you can because you'll have to pay it anyways. Just make sure your payments are timely. But then for deductions, I know there's really interesting to see how our government reworks R&D credit for those who actually use the R&D credit, because that had a huge change beginning of this year, where you can't expense it all at once. It's now amortized over 5 years, meaning it's depreciated, or it's similar to depreciation, but it's taken evenly for over 5 years. So there's all, I hate to bring it up because it's kind of a nemesis, but we hear about it a lot, and check with your tax person on the employee retention credit. And I'm hesitant on saying that because your tax person may or may not be educated in and how that's done. I know as a business owner myself, I'm getting a lot of emails on that, and it's the short answer on that is if you qualify, you will have to pay for taxes because you're paying, you're trading a deduction for a credit, but it's a 50% credit on the first 10,000 of payroll per person in 2020, and $7,000 of the first $10,000 of payroll for each employee in 2021. The advantage is you're trading, like I said, a deduction for a credit, so you're getting that money back in the form of a check as a credit for your employer taxes on your 941. The downside is timeliness from the IRS. Though it's getting better, it still takes a while, and meanwhile, you've had to remove those deductions from your tax return for your business, and so you're going to owe taxes on that extra income or the lack of deductions. So it's a net gain, but it's not a free ride. Whereas the PPP loan was really a free ride. I mean, that was just up and up. It was a free. If you got the loan forgiven, the only thing you had to pay for was either somebody calculating and putting together all the paperwork, or there really wasn't a dollar value much to it other than paying somebody like myself or your employees to assemble all that paperwork. But for other deductions, like Kristine was saying, if you have vehicles, this is a good time to look at the assets of your company, see what needs to be replaced, because that bonus depreciation still exists. And it's something where if things need to be replaced, now's a good time to buy them. Some things are usually on sale this time of year. Some of them wait till January. So I'm of mind, if you want to do it for tax savings, you'll save either this year or next year. But if you want to shop and try to get the best price, some things are actually much less expensive in January. Yeah, that's other things to look at for deductions. Unless if you just keep track of everything, like Kristine's saying, if you are mileage is a big deal. We've got, I guess this time of year also, not just, I guess it wouldn't be necessarily deductions, but just if you haven't quite got the understanding of the new the 1099 non-employee compensation form, from our industry, because all of those are now due January 31st, the 1099s, W-2s. For those who are doing that all internally, that's a lot of work. January is usually a very busy time. So try to make sure you get all your W-9s in this month where it's quiet. If you don't know if your vendor needs a W-9, you probably should contact them. I know it's kind of boring stuff, but that's what we do.
No, that's fine. I think everyone is appreciative of those comments. I do have a quick question for you, then I'll get to some of the comments in the chat. There's some questions there, but first things first, we are in Snohomish County, and the question that we have is tied to our businesses in Snohomish County. How are they doing their taxes? Do you have a feeling or an understanding as to how how do most businesses do their taxes in Snohomish County? And then also, how would you compare doing your taxes to a local representative versus doing it online? So Kristine, do you want to start off there?
Most small businesses, I think, do their own. Whether they use software or some of them we've seen have done them by hand, but I think a lot of, very small business owners, especially when they're starting out, don't necessarily have the money to pay someone to do their books or to do their taxes or what have you. I think a lot of them do them themselves. There is a lot of software out there for which, it's relatively easy to prepare the return. But based on the questions that are asked, the information that gets put in is only as good as the understanding of that question that's being asked. Depreciation is a big thing that gets missed because a lot of people don't know what depreciation is. Okay, or if they misanswered a question, sometimes it's hard to go back and to correct that, so that you then get a series of questions that you really wanted versus what the computer is going to give you. The benefit of seeking out a tax professional is we can provide you education on what you need to know related to your tax return. What kind of business items might you need to keep track of that didn't occur to you, or you've kept every single receipt ever? What do you really need? What do you not? If you were to get audited by Department of Revenue or the IRS, what would you need to keep for that? In what format do you need to keep that? So our job is to provide education and to do some tax planning. How do we make it so that you can minimize your tax liability, not only in the current year, but going forward?
Okay, now we're in a groove here. So I got to ask you, Kristine, what is depreciation?
Depreciation is the recovery of the cost of an asset over a period of time. So, your computers in your office are going to get depreciated over 5 years. Furniture is going to get depreciated over 7 years. Vehicles are going to get depreciated over 5 years. The building we're in is going to get depreciated over 39. Okay, so it's a recovery of that cost over a period of time. I saw something go through in the chat here about, if we purchase a large asset, I can't remember, was it expensive or inventory? Assets that you purchase are not necessarily going to be inventory. Inventory is typically something that you have available for resale, unless you're in a construction business. So assets that are over $2,500 probably should get depreciated. Again, depending on what the situation is, but should get depreciated over the life of that asset. But again, we have choices. Do you take an even amount over the life of that asset? There is accelerated depreciation, where the first couple of years you get the vast majority of that. Or there's bonus depreciation, which for 2021 is 100%. But what makes sense for a business depends on what the financial situation of that business is. If a business is in a loss, you don't necessarily want to take the full amount of that asset, because then you don't have enough income to offset. You want to save that for a year where there's more income coming in. So
okay, that's helpful. Dana, I know you were answering a question in the chat, and I think
I'm trying to get us caught up.
do you want to just highlight the question from Bob, which was, I think you answered it, but maybe just to verbalize it. And I'll read the question. Does the panel believe that Congress will prop up the estate tax lifetime exemption increase before the Tax Cuts and Job Act of 2017 sunsets, and says the sunset is 2025? So
I would imagine that, I haven't heard anything yet. It's not even, it hasn't been even proposed in the readings I've seen from the Secure Act passed in 2019, or the Secure Act 2.0 that's may have a chance to pass this year before the year's end. So that was one of the bills that Kristine was alluding to. There's no verbiage in it because Congress can wait till the next presidential election and go from there to see if it needs to be changed or not. There's no effect to them at this point. They're not being pressured to do anything yet, and that's why it's still just hanging out there. And on top of it all, I believe it was the government. Trying to remember what that department is. The group of our government that calculates how much taxes cost, how much tax laws cost. They said that the Tax Cuts and Jobs Act, if it was extended, oddly enough, that did come out in the last 2 weeks, would cost several more $1 trillion because it gave so much in tax credits to businesses instead of individuals, and it realized that was a huge cut, putting corporations' tax rate at 21% from a regular tiered income level that the rest of us are
Okay.
where we're all taxed at. And the 20% discount on qualified business income deductions that carries over to our individual taxes, though it's great, it's still a lot less than what we paid for in taxes back in 2018 and 2017. And to pay for it, we as individuals lost our our non-reimbursable deductions and the 2% floor deductions. And for those who don't remember, if we all saw it during COVID when we all started working from home, or those of us that had to work from home, businesses didn't have to pay for that reimbursement, and you lost that deduction, which COVID really made that really apparent. And so I think a lot of businesses had to cover some of that so they could write the deduction off. But yeah, I don't think they'll extend it. But it's December 6th, 2022. And, so we're 3 very long years away from hearing that. So, and there's a lot of things that law that move stuff. I saw Bob showing 2 fingers. There were 2 long years.
Dana and Kristine, we do have a question or a comment in the chat that might be worth diving into. It's Mark asks or mentions that his business recently received the IRS examination letter. First meeting set for mid-January, first time for a business in its 30-year existence using the same CPA. CPA will be at the meeting. Is this the increased scrutiny being reported in the news? So any thoughts on this comment that might benefit the audience?
The answer is possibly. Honestly, for most business entities, so partnerships, S corporations, C corporations, the audit percentage is incredibly low and has been for decades. With all of the tax law changes that took place with the economic impact disaster loans, the grants that were sent out, the payroll protection plan that they had, SBA loans, the employee retention credit, reasonable salary, S corporations having reasonable salary. These are all things that were rolled out without a whole lot of forethought as to what the impacts were going to be. As a result, there was a lot of fraud associated with both the PPP loan and the the employee retention credit. So the IRS is starting to look for businesses, especially that had both of those, and then looking at the reasonable salary aspect as well. Keep your documentation. Most of it you need to keep, for the loans and what have you, keep it for 6 years. You need to be able to support any position you take on a tax return. But there will be an increase in the number of audits for small businesses related to those things. But any given year, they pull tax identification numbers or they pull social security numbers for individuals. And it's your turn.
Mhm.
So the fact that you have not had anything from any auditing entity in 30 years is most excellent.
Yeah.
A couple of things I'd like to throw in there as well. When meeting up with the IRS, bring only what they're asking for. No need to bring the whole kitchen, the whole pantry. No, don't need to bring everything. Just bring what they're asking for. Keep it simple and answer questions with fulfilling what they're asking. You no need to give them additional information. It's a very good chance this is what we refer to as a fishing expedition. So Department of Revenue, uh, they do this. They do a very similar practice. So I would strongly recommend just keep it in an environment where if the meeting's set in an office, have that office. If you need to make room for them, meet up ahead of time with your CPA to see if they have a space for them. Basically, what I'm trying to say, a third party or a different location. So so that way you don't get subject to a potential 100% audit. From my industry, that's a scary thing. They will find something if you give an auditor the opportunity, they'll find something.
Mhm.
So it's good just to keep within the confines of what they're asking.
Okay. All right. That's excellent help. I do have a question from Angela about basically asking what's the easiest way to send a W-9 in QuickBooks with our invoices? Any comments there?
So
Dana?
there is a place in QuickBooks to enter your vendor information. A W-9, typically you fill out a W-4 for an employer with your identifying information. That's what is used to generate your W-2. W-9 is for those that are contractors. They fill out the same information, business name, address, type of business entity. For those that are LLCs, they do need to be specific as to what their business entity type is. If you are a sole proprietor, you have to put your social security number on there, even if you have a tax identification number. But there is a place in QuickBooks to go through and enter all of that vendor information. And then, same place that you used if you have payroll, there's a place to go through and issue W-9s through there. Otherwise, there is software out there for which you can potentially electronically file for those that are not using QuickBooks. But anyone over $600 is supposed to get a 1099 at the end of the year.
So, and that comment is in connection to Carol's question, I believe, which is, can you explain more about the $600 threshold for transactions, considering Venmo, PayPal, et cetera, with how that affects businesses versus personal transactions?
So $600 has been the threshold for the 22 years that I have been doing taxes. But typically it has been for those that specifically are self-employed, someone you're paying rent to, lawyers that you're paying, fishing, medical. There's 10 different boxes that are on your 1099 miscellaneous form. They had pulled out non-employee compensation and put on a form of its own a couple of years ago. Last year, 1099 NEC came out. During COVID, everyone and their brother started a new business. A lot of people were selling stuff on eBay or whatever. So one of the things that changed this year is if there are transfers of over $600 to anyone, a 1099 is going to be issued. So a lot of people that just transfer, they're just transferring money to a friend, reimbursement for, I don't know, dinner or whatever it is. It isn't necessarily self-employment income. It doesn't necessarily end up needing to hit a tax return, but it's the IRS's way of capturing all of those who have been doing business online for a lot of years and not reporting it. Because nobody knows I don't have to report it. Well, that's not really a thing. with the IRS if there is income being generated for a business purpose. It does need to get reported. But yeah, there are going to be some 1099-Ks, and a 1099-Ks get issued from a third party. Okay, so credit card or a Venmo or Zelle or what have you, those third party transfers.
Okay.
Wow.
Dan, you want to add to that?
Well, I'm just a little scared about it because thanks to COVID, finally, we're finally at the other end of COVID. Um, my my family has also grown, and on my mother's side, and I was talked into hosting and finding a place to rent out for the family gathering because we didn't want to. No one person wanted to host 50 people, so we rented a place, and I'm wondering, people are, I'm about to get about 40 Venmo collections. So I'm wondering if I'm going to have to report that as, I can't, I'm just looking at that going, that's not income to me, really. So anyway, so I might have to write a letter to the IRS if they question it, but
I see.
I'll cross that bridge when I deal with it. But yeah, Kristine's right. When you pay folks for, you need to borrow money, Venmo or these other merchants don't really care, why. It's the question of why you're paying money to somebody else isn't in there. It's, here's the transfer of money. You get to explain this on the tax return. And I hope the IRS doesn't take the stance of, hey, this is income, where in actuality, in many cases, it won't be.
Yeah. I guess tying in some of the conversations about tax groups that you all spoke about earlier, I'm curious about whether there are specific tax groups that better cater to specific business entities, and if you could speak to that a little bit.
All right, I'm okay. As far as business entities, yeah, I see what, yeah, so everybody's a little different, from our perspective. There's I prefer doing, actually, me personally, I come from preparing financial statements and doing third-party financial statements for businesses. But I also do taxes. So, for our firm, we do individuals and businesses. Some businesses specialize in not-for-profits. Our firm does not, for example, the things that our firm does not do is what are called 5500s, which are like 401k and a retirement plan returns. Those also require a return to the IRS. We just don't do those. I haven't done one in about 8 years. So, and but for other entities, we're seeing a huge increase for the Washington State estate returns, because unfortunately, the limit hasn't really increased with inflation. So a lot of people are crossing the threshold of 2.193 million in their estates, and so we're having to prepare a lot more of those. One thing that if I could also bring up to the crowd here is, if you haven't had a chance to review, if you have a will, it's a good time to review it with your CPA and your lawyer, because of this very thing. If you're looking at potentially having an estate worth over 2.193 million, and you want to avoid Washington state taxes for those who would benefit, those who are your beneficiaries, now's the time to take care of it. I don't see this Washington state. I haven't seen anything from Washington state increasing that rate, but we've all certainly seen increases of our properties and values. Maybe not your 401k. I know this year's been pretty rough, but for everything else, it's been a lot of inflation, or a lot of price increases. And yeah, I was talking to another CPA 2 weeks ago. He's like, I must be on a world record. I'm doing 7 of these 706s for the state of Washington. I've never done more than 2 at a time, and now I'm doing 7, and our office is doing 5.
Mhm.
And before this year, I've never done more than one at a time. So, that it's just, I have a feeling, unfortunately, it's going to be more and more common, and it's our job, in my industry, and Kristine's part of this, is we need to make our community aware that this can be an issue for for your successors, for your beneficiaries.
All
So
right. Thank you, Dana.
yeah.
Kristine?
Not all tax professionals have the same experiences.
Mhm.
Even though you might have been doing taxes for 10 years or 15 years, doesn't mean the same types of things cross your desk.
Mhm.
Our firm, we do 990s. Do we like 990s? We really don't do enough of them that it's, we can, but it takes us longer. There are companies that specialize in that. Doing the Washington state estate tax return, I refer it to somebody across the parking lot. They do a lot of them. They do it well. That's their specialty. That's
Mhm.
not mine. I mean, I can get through it, but it's not necessarily going to be a good use of time. They're going to be able to provide a better value than I know I am. So each tax professional, each group has different areas of expertise. So if somebody is looking for a tax professional, be specific about what you want. What are your expectations? What is your business entity type? What sort of help do you want? Do you need financials done for you? Do you need the auditing aspect that can be provided by a CPA? Do you need someone to do payroll and bookkeeping? Making sure that whoever you seek out is able to meet all of what your needs are, because just because someone's been doing it for a long time does not necessarily mean that they have
Mhm.
experience in doing that. A lot of people think they need CPAs. Not all CPAs do tax. Not all CPAs like tax.
Mhm.
So am I wrong?
Can you speak to, can each of you speak maybe to, because there's been a lot of shifting, right? There's a lot of remote work that took place over the pandemic. How's that impacted, I guess, the accounting industry, CPA wise, IT? Has that shifted in your realm? Have you seen that shift? Where you say some CPAs don't do bookkeeping or tax element work? Do they do IT work now? What does that look like?
I get, CPAs do more of your accounting related things
Mhm.
versus the tax aspect. But there is definitely, at least from my perspective, been a shift in the industry. A lot of clients would normally come in, drop off information to have their tax return done. They'd come back. We would finish up in person. A lot of that has gone to Zoom.
Mhm.
There are a lot of things that, we can still provide that office experience via Zoom. I can see you if I'm explaining something. I can tell whether or not this is sinking in versus, you're doing the dishes in the background or what have you. A little different than a phone call. So, it provides us an opportunity to share screens. We can still provide that education, those resources for clients, very similar to what an office experience would be like.
Mhm.
But people are working from anywhere and everywhere now. I've got clients all over the country. This has allowed them to stick with their same professional
Mhm.
because of Zoom and the electronic aspect.
Well, we're down to the wire here, and I think you all have given us great information. I want to give you all the remaining time just to give some lasting words of advice to our audience here, and please highlight again your organization. If you want to highlight the size of your organization, where you operate, that would be great too, and your expertise as well. So Dana, you take the first word, and Kristine, you take the last.
Okay. Well, I hope this meeting has been helpful for everyone. And there is a quick question on, I'll do a quick answer on the Washington State tax, or what estate tax. If you gift it, that is one of the ways to avoid it. Not everybody wants to gift stuff, and you can also use trust to set that up. You could gift stuff to a trust. Mind you, when it's not cash or something that is easily set for value, you have to get an appraisal for it when you gift it, and you get to file what is that, 709 form, I believe. And though it's an informational return, and it goes again, when you gift more than the exemption, or what is that, 16,000 per person this year, it's 17,000 next year. It's gone up twice in the last 2 years. That's a record in my lifetime, I think, because of inflation. That if you gift more than that 16,000 per person this year, it is required to go on there, and it also reduces your lifetime, which falls into your, when you pass your estate exemption. And the benefit of that state of Washington is that, it lowers your estate value. The downside is well, that's going to take some planning. So that's by person to person. I would never universally say, hey, there's how to avoid it. You just give it all away. That's not for everybody. So, and it also depends on who you give it to. And you actually can give it to a trust. That's how you can set up a trust, and through trust you avoid some of that estate tax. But other things that, keep an eye out for any of the news, because unfortunately our Congress, hopefully they're tired from all this COVID stuff and this election they just had. Unfortunately, in the last 10, I can go back to 2013 of that tax year, where they, unfortunately have had a bad rap, or they consistently passed laws in late December, or even worse, early January, to retroactivate into the year that we're trying to plan. So, according to the, I'm sure Kristine remembers hearing this in classes. According to today, it's December 6, 2022, this all stands. Tomorrow may be a different story. And, if anything comes up, talk to a person that, that does taxes, like Kristine or myself.
Thank you. Thank you. Kristine, do we want to have some parting words?
Yep. Just, end of December, there will be changes. What we've told you today will stand. There will be changes before the end of the year. So for small business owners, I guess a recommendation would be get organized now, get your books caught up now, track down your envelopes of receipts now. It's just much easier than trying to scramble and do that in March when you're trying to get it done. If you've got questions, by all means, reach out to your tax professional. There is some time to do some planning before the end of the year. Quarterly payments go in January. So, at the very least, if payments need to go in to minimize what April is going to look like, when people tend to have property taxes on top of that, you've got some time to do some planning before the end of the year. So. All
right. Well, I want to thank both our panelists today, Kristine and Dana, for giving us a wealth of knowledge going into tax season here for our small and large businesses in Snohomish County. I think we will pull up a screen that might share some additional information for you all, but we will share this link out, and it'll go through also our newsletter. Usually shares a piece of this, and it'll have a clip so that you can connect and watch the presentation that you received here today from Dana and Kristine. I want to also highlight that, again, we are very appreciative of your efforts. We have today push forward for our most recent installation of the coffee chat. However, also today is the forum, which is diversity, equity, inclusion, and it's tied to our Snow Code program. And we are going to have Dr. Anu Taranath speak on some elements of diversity, equity, inclusion. And so this again is today from 11 a.m. to 1 p.m. There will be food. It's at Edmonds College. Be there or be square. And also, just to highlight, we are in our last Coffee Chats episode of 2022. So you got to end it with some amazing tax preparation information from Kristine and Dana. Again, we want to thank each of you for speaking today. Remember, there's the CPA group and the Tax Partners Northwest if you're looking for some support. Now is the time where you all know we generally share our screen. And Kristine and Dana, if you happen to have coffee or a cup of water next to you, now's the time to raise that cup in solidarity with EASC. Hopefully that is a tax write-off as well. Just kidding. But everyone, please hold up your cups. We thank you for joining EASC again for another installation of Coffee Chats. If you have suggestions for future Coffee Chats, reach out to William and Rachel. They have been the amazing staff pushing these efforts all year behind the scenes, coming up with many Coffee Chats that you've seen, the topics, the panelists. They've done the amazing work. So if you ever want to reach out to thank them, William's on the screen on my upper right. Say hi, William. And I don't know if Rachel is on, but these are the folks who are doing the heavy lifting and behind the scenes. So thank you all for joining us again, EASC Coffee Chats. Take care.
Thank you.